Thanks for tuning into Alpha Moguls, a show where we speak to some of the finest investing minds about how they are thinking about the portfolio construct at the current point of time or at any given point of time. Our guest today is Swanand Kelkar. He's managing partner, Breakout Capital Advisors. He comes in his new avatar for the first time on BQ Prime. Swanand, great having you. Thanks for taking the time out.
Thank you so much, Niraj. Always a pleasure speaking to you.
So, Swanand, all our viewers have been attuned to you being in your pre-COVID avatar of the fund management business that you used to do then. Just give us a small brief before we start talking about your thought process. What do you do currently?
Yeah, okay. So last year, we started off this firm called Breakout Capital, which is an emerging markets focused listed equities investment firm. And we have offices in New York and here in Mumbai. So doing what we were doing at Morgan Stanley in my earlier avatar, but this is a much wider remit in terms of the fact that this is an absolute return focused emerging market fund.
Okay. So you don't only look at India, but you probably look across the emerging market pack for your investments of the advisory that you manage.
That's correct. So we have a team, obviously. It's not that I do all of it, but we have a team of investors who look at the entire emerging markets, both from a macro standpoint as well as from a bottom-up stock picking standpoint.
Got it. So, Anand, so tell us a bit about how are you thinking about the investing landscape currently? I mean, at all-time highs, things are never in your favor when you look at valuations, but the story seems very promising at any given point of time when we are at all-time highs. I'm talking about India currently, or maybe we start off with the emerging market landscape, because a lot of people say that the time for emerging markets is here and now, and the next few years will belong to EMs versus DMs.
Yeah. So when you said all-time high, I was just wondering what you're talking about, because if you look at the MSCI Emerging Market Index, that's been sort of stuck in the same range now for almost 15 years. And that's one of the pushbacks that we get when we speak to investors, that here is MSCI EM, which has been at the same level, I think, since 2007 in dollar terms. What's really happening there? So I think to talk about EM first, I think the entire term emerging markets or the construct of the MSCI Emerging Markets Index is just a lot of disparate countries thrown together, right, which have at times very little in common. So there are commodity importers, there are commodity exporters, there are countries which are leveraged more to the exporting, manufacturing exports. There are countries driven by domestic demand. There are countries which are following different fiscal and monetary cycles at different points in time. So what happens is that in aggregate, at any point in time, there are different countries pulling in different directions in terms of where they are on the cycle, and which means that the index is like a twin-engine plane, but those two engines are generally pulling the plane in two different directions, which means that the plane stays where it is. Which has been sort of an issue with the index, and which sort of does a disservice to emerging markets as an asset class, because people look at the broad index and say it's going nowhere. But if within that index, if you look at individual countries and in the same 15-year time frame, you'll find countries which have doubled, more than doubled, almost tripled in dollar terms. And that obviously includes a country like India, but there are other countries also which have done reasonably well. So I think the important thing to know when you're thinking about emerging markets in general, we think about it more as an investable universe. We don't really think about it as one large cohesive economic index which is going to be dictated or moved in a certain direction based on economic parameters. We just think about it more as an investable universe for us. And then we follow a two-pronged process of picking countries and then picking stocks. So large countries like India, China, Korea, Taiwan, we will always have some exposures there given the size of the opportunity there. But for some of the smaller countries, we are very, very selective. We are very macro-led in investing in those countries, and we will invest in those countries only when we feel that the macro situation in those countries is doing reasonably well.
Got it. So, Anand, I mean, you have access to multiple global think tanks, brokerages, and you guys think about all of these economies as well. Does it look plausible by virtue of the fact that at some point of time rates might come off, maybe in 2024, if not 2023, certainly, going by the scheme of things, that risk assets like equities provide a good alternative by and large? I know every country is different, but I'm just talking about the asset class by and large. Or is it that in some cases like India or some of the other, like NASDAQ, for example, that things have run so hot. And since rates are not going to come back down in a hurry, it makes sense to be a bit cautious on equities currently.
Sure. So very hard to answer for entire equities as an asset class. But if you look at the last decade, which is the 2010s, it has been primarily about US, right? I mean, it has been, in a way, the US markets have done very, very well, and most other parts of the world have not really done anything. And whatever little emerging market performance that we have seen has also been tech-led, especially in the last 2-3 years of the last decade. And it's also been a very tight market. It remains a tight market even today, as you can see from some of the US indices and the decomposition of the, let's say, the S&P returns. So it's been a decade of primarily US and primarily tech. And the bet that we are making is we are taking the other side of that trade. We are saying that here is a time when the growth differential between many of the emerging markets versus developed markets is starting to expand. So if there is one indicator, macro indicator, which has a reasonable correlation with future equity returns in a developed versus EM world, I would say is nominal growth differentials between the two economic blocks. The other thing, obviously, is the US dollar. If the dollar keeps strengthening and remains very, very strong, I think the dollar returns that you can generate from the rest of the world, including emerging markets, is generally weaker. So both those trends, I feel, have turned and are in favor of investing outside of US, which has been the only story for the past 10 odd years. Having said that, the first 6 months, the market has proved to be very resilient on an overall basis in the US, but it is based on certain very, very tight pockets of strength. So yeah, so I would say that given the situation that we are at, it makes sense if you're a global asset allocator in equities to diversify away from US and developed markets.
Got it. So when you are thinking of a portfolio approach, what's the preference that India gets in this consolidated EM portfolio, if you will?
So I think India is the place to go to in terms of stock picking in any emerging market portfolio today, right? I mean, a lot of people have, I'm sure, come to you as well. People write this in press that we are a sweet spot, we are, an island of calm, whatever. And that is true. If you look at any emerging market portfolio today, I think the incremental money is coming into India. You see that in the FII flows as well. And there are obviously two broad reasons to this. One is the reasons of exclusion. So what's happening in other parts of some of the other large parts of the emerging markets. And the other reason is obviously the bottom of India story looks reasonably good. So I think India is a big part of our portfolio as well. And we are invested in India. I mean, one, because we understand this market really well, having been investors here for decades. But intrinsically as well, we think India is a good place to look for absolute returns over the next 2 to 3 years.
Okay. So, and you reckon that these absolute returns would come into play over the next 2-3 years, independent of where we are right now? Because for a lot of people who I talk to, not on Alpha Moguls, but on my show Talking Point, some of them say that the starting valuations are a bit of a concern for them.
Yeah. So if you ask people about India today, right? I mean, here are the 2 or 3 consensus things that you always get to them. I think everyone is broadly convinced about the big picture story. Everyone is broadly convinced about the fact that there are enough and more corporates and good quality corporates out there for you to be able to express that in a portfolio. And the constant worry that everyone has is valuations. Right? Where do you make? So any talking head, and that includes me, will have these 2 or 3 things that we will talk about in the interview. Right? So I think the macro story is sort of well understood. There don't seem to be material storm clouds on the horizon.
Save for elections?
Sorry, say that again.
Save for elections. I mean, would you brace yourself for any volatility due to an election verdict not quite coming the way the markets want?
Yeah, I mean, I'm no political expert here.
Of course, neither am I.
The chatter about elections, electoral outcomes has started to creep back in. It's, I think, nobody's prerogative to predict how that works.
Agreed,
But
completely.
I would think from a market standpoint, what I still not worry about, but I keep an eye on is our current account deficit situation. And it's all under control, and everybody's very excited about services exports and what that means for keeping it in control, etc. But there are two things which I sort of not worry about, but I keep an eye on for the next 2-3 years standpoint. One is the fact that whenever one country is growing really fast relative to the rest of the world, it always creates sort of a tendency to import more if you do not have a lot of your own manufacturing, and that's changing. I know that. But think about 2009, 10, when India came out of the GFC as it is called, reasonably unscathed and was growing really fast. And the current account and the fiscal deficits widened over the next 2 or 3 years. So when you are growing really fast in a slowing world, your exports engine is not firing as much, but you are growing quickly, which means you're importing a lot, which creates deficits for you. So we have mitigating factors this time around, especially on the services side, remittances, etc. But keep in mind that we are a large economy now. So even a 2-3% fiscal deficit means that you need to get at least $80 to $100 billion of outside capital to bridge that current account deficit. And this is one number which as a share of GDP might look small, but there is merit in looking at that absolute dollar value of that current account deficit as well. Because it basically means that you are importing savings from the rest of the world. So somebody has to write you that check either in the form of an FDI or an FII money coming into equities or debt or banking capital coming through. And this is not just true for this year. For the next 4 or 5 years, I think every year we should brace ourselves to do what it takes to get $80 to $100 billion of money in through the capital account route, so that this equation remains nicely balanced and doesn't create any sort of hiccups. I half jokingly say that the entire country, including government, corporates, fund managers like us, need to be in the investment banking mode for the foreseeable future to sell a good story. I'm not saying that this is not a good story, but you have to go out there and showcase the India story to attract the kind of capital numbers that I'm talking about. So that's one, not to worry, but something to be careful about. Keep a watch on. The other thing which I worry about is, I'm sure you have heard and a lot of experts have come and spoken about the K-shaped recovery that has been happening over the past 12 to 18 months, right? As we emerged out of COVID, it is a certain section of the society, the population that has economically well off, has continued to do well. And sort of the lower strata is still not fully recouped from what happened during COVID. I watch that situation a bit more closely because it has multiple, apart from economic, I think it has social implications. It has unemployment related implications as well. So I watch for that, and what will make me even more confident is if this recovery is more of an even key, where all parts of the economy and the society are benefiting equally from the growth of the country. Coming to valuations, I think having spent some time looking at many other emerging market countries, I think I have now learned to count the blessings that we have in India. A lot of things that we take for granted. It's only when you look outside that you realize that these are not birthrights. And they're very simple things, right? Like a democratic, peaceful transfer of power happening after elections. The military never comes. There are no tanks that get rolled into the capital. Markets have remained open at all points in time. There have been no controls on capital going out. So if you're a foreign investor, you sell, you can take money out. The RBI is an institution which is independent, orthodox, responsible. The government has been in general fiscally responsible with what it has done over the last 2 or 3 years. The regulators have been reasonably transparent. There has been not much stroke of the pen risk, right? That industries or large companies evaporate overnight just because somebody signed something into a law without giving enough advance heads up. So all these things you cannot put into the earnings number of 1 year, but all these soft factors, I would say, somehow contribute to the multiple that a country gets. This is more art than science. It's hard to fit this into a DCF, etc. But having looked at a lot of the emerging market economies over the past couple of years, I think counting these blessings has become more intuitive to me. So having said that, it doesn't mean that we are valuation agnostic people. I mean, we have had this discussion many times in the past. Although we are not value investors, we pay attention to valuations. And we believe, fundamentally believe in the fact that starting point valuations have a fairly high correlation with your future returns. So if you are in that camp who believes that this is a game of probability and your probability of making good returns increases if you get in at reasonable valuations, then obviously it's a bit hard. It's a hard place to pick stocks. We're just doing this analysis that one third of the top 100 companies in India today have a FY24 PE of more than 50. And this is unprecedented, right? So, just having this valuation. So, if you care about valuation, if you pay attention to these things, you are not going to jump headlong into some of these stocks. I think it is important to be in the right places. It is important to be in the right areas if you want to make that kind of an absolute return, which is how our portfolio is skewed as well. Just to give you a sense of it, we have zero consumer staples. We have zero consumer discretionary except autos. We have nothing in the new age tech space. Right. So that's how the portfolio is constructed because we want to play the growth, but are conscious of what valuations we pay for that.
Interesting. So where is it that you have the highest presence, Swanand?
So I would say the investment side of the economy, to give you a very broad answer. And that includes cement, that includes engineering, construction companies. We like financials in general. We like real estate as well. I think those are the sides of the economy. So we have the clear sort of call that we have made is that given valuations and given growth contours, we want to be on the investment side of the economy rather than on the consumption side. We made exactly the opposite call probably in 2009, 2010. When there was a large fiscal stimulus which came through, there was money in the hands of people. And this is a very interesting sort of numbers that I was looking at. When everybody is aware of Hindustan Lever's lost decade, right, between 2000 and 2010, when sort of EPS for Hindustan Lever doubled and the PE halved and the stock went nowhere. I think it was a similar decade for Larsen in the middle 10 years between 2010 and 2018-19, where it was all the consumption side of the economy which was leading the charge. And we heard about investment paralysis, and we heard about private sector capex or capex in general being very weak in that period. So I think these decadal shifts happen. I'm using decadal very loosely. Need not always be 10 years, but these shifts in the main growth drivers of the economy happen. And I think one such shift has happened over the past couple of years, where I think investment side of the economy is much more in charge than the consumption side of it.
Interesting. This investment side, Swanand, again, I hear two theories, and I would love to understand what is it that you are thinking when you're keeping these stocks in your portfolio. The ones which have very niche capabilities, are inclined towards automation, can undertake capex because even if it's not used in India, used abroad, all those companies are priced in a very punchy fashion currently.
I agree.
So do you go there, or do you go towards the lower valued names in the hope that there will be a bit of a valuation drift towards the higher priced ones?
No, so I think what we have done is we have stuck to large cap because that's the construct of the portfolio, right? The entire portfolio is 40 stocks. By entire, I mean entire emerging market portfolio. So in India, we have a single digit number of stocks. So it's not like we are going down the cap curve, but chunky positions. So individual positions are large, which means that we have limited leeway to go and buy into some robotic or AI related name, which is a very niche sort of a play. And I fully buy your point on valuations there. So we have stuck to the frontline sectors, and that is typically EPC, that is typically cement, maybe a bit of manufacturing and manufacturing related things in the portfolio. But these are 3-4 names, right? So we do not have to go very deep into the sort of the woods of the mid and the small caps to get names there. But I agree with you. I mean, some of the valuations in those places, they fall into that more than 50p sort of bucket.
And therefore, even if you had a chance to add them, would you stay away, or would you believe that the EBITDA curve can be very steep and therefore people who want to can look at them, independent of what you are doing? Yeah.
No, absolutely. So it also that answer is more about who you are as an investor. I mean, it's more about you. And there's a great Urdu word for it called tasir, which is what is your essential character as an investor? Who are you? I have the entire firm is geared that we are more GARP investors. And a friend of mine has a great, and now that you mentioned it, has a great line about it. It says that some businesses you have to value with your eyes open, and some businesses you have to value with your eyes shut. Which means that you have to imagine what this can turn out to be 10, 15 years later, and not look at the current numbers.
But you are not doing that.
We are not in that camp. We have always been in the camp which likes or understands or do things with our eyes open. We are not very good at doing things with our eyes shut. And there are investors, and typically there are a few of them. It's a very rare skill to have, who are called visionary investors who see the future. It's a hard thing to do, but there have been people who have been successful at doing that, but we are not there. So we try to look for the conventional way of investing. We are okay to have long holding horizons on stocks. We are okay for stocks to keep doing well, and if in that process it means that there is a valuation creep upwards, we are okay with that. But generally, we balk at buying something which is trading at 2-3 standard deviations versus its own history. We generally steer clear of that.
Got it. Swanand, last couple of things. I mean, maybe you don't have a presence there, but you may have thoughts there. And which is because you look at EMs, there's so many theories around this rising per capita to GDP income and how it's played out in other emerging markets or Asian markets, and thereby correlating to what could happen in India. Now, do you think about it from that perspective at all? And would the beneficiaries typically be similar, or do you think in India's case it could be dramatically different? And what could those be?
Sorry, sorry, what's the last part?
And what could those themes be?
What could those beneficiaries? Sure. So I think I'm quite skeptical of charts which show per capita consumption of X versus Y. And those charts were very popular maybe 5-7 years ago. So you had India's per capita consumption of beer, and next to that you had China, and next to that you have US. And you have per capita consumption of soap, or per capita consumption of shampoo, or whatever, with the almost unsaid easy thesis that these things are going to converge. So I mean, it's so simple. What are you waiting for? Or you had per capita or per household ownership of cars, but that doesn't really happen, right? So if you look at the largest consumer company in India and look at their last 10 years volume growth, it will be less than 5%. So what happened to conversions? So, and why is it not automatic? And why is it not happening the way it was promised? So I think I'm very skeptical of these per capita GDP sort of investment rationales, especially in a place like India where you have 140 crores in the denominator. Every number is going to look small. And by that definition, if you put other countries next to it, it's going to look attractive. And that's true for any. So don't really pay much attention to that convergence. But I buy the point that at certain levels of per capita income, and as you keep crossing those thresholds, the propensity to consume certain items changes. So your consumption basket starts to change. So you move away, let's say, from the low-end food and staples consumption to a bit more discretionary consumption. And from discretionary, you move to luxury consumption. That continuum I buy. And we are evolving on that continuum. I mean, let's say the very, very low-end FMCG volume growth is insipid because we have sort of reached the penetration numbers there. Now we are moving more towards the slightly discretionary, aspirational sort of consumption items. I'm also a bit skeptical of drawing parallels straight from other countries into India on the consumption side, because every country has cultural differences. Every country has its own evolutionary path, which is not sort of a classic path that everyone takes. So to give you an example of, let's say, air conditioners or room cooling or just the cooling industry, and people say that, okay, at a certain per capita GDP, this inflex, India is a hot country, there is so much temperature rise, etc. But that doesn't mean that you won't have that 2-3 year cyclicality, which will be very, very steep and will override the sort of, even if there's a secular story there, it will override that secular story with these cycles of competition, cycles of inventory stocking, destocking, raw material inputs, etc. Where that secular story, this impact on the stock performance is very, very limited versus the overriding 2-3 year cyclical factor. So yes, we do look at the experiences of other countries. We look at how things have changed. We keep that in mind, but we are very, very mindful of extrapolating those things as is, not just in India, but in any other country.
So are you guys playing the luxury consumption theme from a multi-year perspective or working on that at all?
Yeah, so I think in the emerging world outside of India, we have some exposure.
Okay, but not within India.
We have some exposure, but within India, no. So as I said, we have nothing on consumer staples and nothing on consumer discretionary except ours.
Yeah. You said that at the beginning. Okay.
That's correct. Yeah.
My final question, and that is on something that I heard you say you have within your portfolio, which is real estate. Now it's a sector that's kind of risen after a very long hiatus, but it's now been up and about for a couple of years. People say these cycles are very long and strong when they start. Do you believe we are in the midst of a real estate upcycle? Any thesis on how long could it last and what kind of players could benefit? You may have exposure to maybe one because you have a very concentrated portfolio, but there might be others which can benefit as well. So just give us your thoughts around real estate.
No, so I think, as you rightly said, right? I mean, these cycles are long drawn out, and there was this long sort of a maybe 8-10 year period in which both volume and prices were down together. From a sentiment standpoint, and we have been a bit surprised by this, from a sentiment standpoint and from stock prices doing well standpoint, I think this sector is very tightly correlated with the interest rate changes. Although in India, you can argue that the underlying demand is just so strong that maybe 200-300 basis points of interest rate changes here and there do not affect it. But you can just look at the stock price performances of these companies, and you had this maybe a 10, 12, 18 month period till 2 months ago when the stocks were doing nothing, despite the fact that operationally all of them were doing reasonably well. So I think there is a tight correlation with your outlook on where the interest rates are going. I mean, globally, it's an interest rate sensitive sector, although not so much in India, but stocks tend to behave that way. Yeah, so I mean, if you look at high frequency indicators there is nothing to suggest that the cycle is turning. The cycle seems to be strong. We have preferred residential versus either office or commercial. So residential is what we like. And metro residential are the only plays that are available in the country. So we have one of those. The cycle seems to be, for now, going reasonably well. And the reasons, the underlying reasons are intuitive to understand, right? I mean, people are looking for home ownership, especially after COVID. People are looking for slightly larger homes. There has been a lot of inventory clearance. There has been a lot of consolidation on the supply side of things, given where the sector has become much more cleaner in terms of disclosure, or at least the top few players benefiting. I mean, those are the common themes which you have seen which are being talked of in the sector, and we think that the cycle remains intact, at least for now.
Great. Swanand, before we wrap up, what is the Alpha Mogul managing such a large portfolio doing beyond investing?
Oh, tons of things. So as you know, I mean, I had a year-long sabbatical and I did multiple things during that sabbatical. And I've carried some of those interests forward. So I think the 2-3 things which take up most of my leisure time is I'm still playing a bit of cricket, not professionally, but I still go to nets, play a bit. My yoga, meditation, fitness, that part is still continuing. And I write I want to keep my writing habit intact. I'm not writing any newspaper columns, etc., as I used to earlier. But I write a small note for friends, maybe once a week, just to keep me in the writing habit. Yeah. So those are the things. I'm also involved in a few charities. So that's what keeps my leisure time
Well,
leisure time occupied.
I look forward to receiving that note, Swanand. Still haven't gotten one, so look forward to getting that soon.
Okay, my bad. I thought that you were on that meeting. I'm sorry.
Nevertheless, but thank you for talking to us today. Love your book club, love your thoughts, Swanand, and great talking to you today on Alpha Moguls.
Thank you so much, Niraj. It's a pleasure as always.
Yep, and the pleasure is ours. And viewers, thanks for tuning into yet another episode of Alpha Moguls. A different episode in that we didn't talk about intricacies of just an Indian portfolio, which we did in pieces, but more about how somebody's looking at world markets at large, thinking about India within that, and a broad brush on India. Hope you found it useful.